investment demand for physical silver drives the long-term price. The long-term price then drives mine production, secondary recovery, and fabrication demand. Good afternoon. It's Jeffrey Christian of CPM Group. It's about 12:15 in the afternoon on Friday, the 12th of May. I'm going to talk relatively shortly today, if that's possible for me. I want to talk a little bit about gold and silver and the debt ceiling. And then I want to talk a little bit about the truth about silver. I only really have one chart here, and this is the silver market balance. And one of the truths about silver is that the silver market has not been in a deficit for the last 4 years. That's marketing hype. You do that by saying, okay, let's redefine what market research is and what a market balance is. And let's say that it's total supply, and we'll throw in some dummy variables for futures use of metal, which doesn't really exist. And then we'll also throw investment demand in on the demand side along with fabrication demand. And once you add that investment demand in, you've got a deficit. It doesn't actually happen, but we'll get back to that. Let's talk a little bit about gold and silver and the debt ceiling. The debt ceiling issue is stirring around, and it's causing a lot of angst and uncertainty in financial markets. CPM Group issued gold and silver trade recommendations, these short-term recommendations that we do. We issued new trade recommendations for gold and silver today, and we said stand aside. With the gold price, I said the price of gold could, the gold price has traded between $2,004 and $2,027 today. It's about $2,015 as I talk. Silver has traded below $24 and up to $24.40, and it's trading just above $24 as I speak. And our view is that the issue is related to the debt ceiling negotiations or impasse or whatever you want to call it. In Washington could push the gold price up $40, and it could push the gold price down $40, and it could do both over the next couple weeks. Silver, similarly, you could see the silver price go up $2 from where it is today, and you could probably see it go down 50 cents to $1 from where it is as I speak right now. So there's a lot of volatility and a lot of uncertainty, and it could go either way. If the impasse continues and we actually move toward a quasi-default of some sort, that could push gold and silver prices higher. But there are several things that could happen that could push the price down. One is a resolution to this. I think most Democratic politicians realize that as this passion play plays out, it's negative for the reputation and the creditworthiness of the U.S. Treasury and the U.S. Treasury securities. Even in the absence of a default, this kind of bad behavior by politicians running the government is bad. And you do have some portion of the Republicans in Congress also understanding that it's bad and this melodrama should be stopped. You don't need to go up to the last minute. Second thing is there is no such thing as a last minute here, and you really have to understand the mechanics. So there probably is going to be a resolution to this impasse over the debt ceiling at some point. And probably the resolution will be negative for the Treasury's reputation and the U.S. government's reputation. They've already done a lot to damage to worsen the low esteem in which Washington politicians have been held worldwide, and they could do a little bit more. But a resolution would remove this, and you could see the gold price and silver prices come off on that resolution. Another thing is to watch for the rhetoric. In the mid-1990s, the Republican-controlled Congress held the Treasury hostage over a debt ceiling and a budget, and we actually had a furlough of the U.S. government. The U.S. government shut down for a while for a lack of funding, and this impasse went on for a while. There was a press conference, and Robert Rubin, who was the Secretary of the Treasury, was asked by one of the reporters, what are you going to do about funding the country? And he said there are several things that we can do. One of the things that we can do is we have 261 million ounces of gold in Treasury reserves. We could sell those, and back then, 261 million ounces of gold at, I think the price was around $360 an ounce, could fund the government for 3 to 6 months. Well, the Western gold mining interests called up their representatives in the Senate and in the House and said, we really don't want the Treasury selling gold. And the budget impasse was resolved within a couple days. I don't know that the Biden administration would do that. I don't know that they have the mental capacity to do that, but they could. And it could hit the gold price. They also could invoke the 14th Amendment and simply ignore, well, not simply, but ignore the debt ceiling legislation, because they have an obligation under the 14th Amendment to make sure that the government is funded, and they can do that. So right now, the debt ceiling is holding the world hostage, and it's holding gold and silver hostages, and we would just sort of stand aside for a while. As I said, we issued gold and silver trade recommendations to our clients today, and those recommendations discussed some of these things. Going beyond this, we do think that you might move into the summer doldrums. You could see the old adage that has applied in recent years, sell in May and go away. You could see the gold prices and silver prices modestly decline and trade sideways for the next several months. We still expect prices to rise further later on in late 2023 and into 2024 and 2025. But right now, the uncertainty over Washington politics are such that we are telling our short-term investor clients, stand aside. And if you're options-oriented, probably buy a straddle to take advantage of the idea that there's going to be continued volatility. Next Tuesday, the 16th of May, CPM Group will release its annual silver yearbook for 2023. We're in the final throes of producing it right now, and it will have our data on supply and demand and market trends and inventory levels and inventory movements and investment demand, which is separate from fabrication demand, quite distinct from fabrication demand, and prices, including projections for 2023. That'll all come out. We will be doing a briefing on it on Tuesday morning. You may go to our website, cpmgroup.com, and register to listen in and watch and ask questions at the briefing. And you can also go to our website and order it. This is our supply-demand balance, which is done Commodities 101, basic commodities research basis, total supply, mine production and fabrication, secondary recovery, less fabrication demand. And you can see that there are big periods of surpluses and big periods of deficits. And you can see that big periods of surpluses tend to correspond with higher prices, and big periods of deficits tend to correspond with lower and flat prices. And what you're seeing here is the role of investors in the silver market. When investors want more silver, as they did in the 60s and the 80s and since 2005, they bid the price higher. They buy silver, and as the price rises, that confirms that they should be buying more silver, and they buy silver which has the effect of encouraging increased mine production, encouraging increased secondary recovery of silver from scrap, old jewelry, old silverware, electronics, and other stuff that has silver in it. And it also discourages fabrication demand. When investors are bearish on silver, they sell, as they did from 1990 through 2004, 2005. And then that period of time, they sold close to 2 billion ounces of silver. And the price went down to about $3.50 and traded between $3.50 and $5 or $5.50 for much of that 15-year period of time. You can see that, there's this initial surge to buy and then it diminishes. There's an initial surge to sell and then it diminishes. We saw that diminishing after 2012 in the silver market. It got very low. Take a look at those last 5 bars here. 2018, 2019, the price, investors were buying 50 million and then about 40 million, a little bit less than 40 million ounces of silver on a net basis, physical silver bought by investors on a net basis. So you have you have buying and you have selling, and it nets out to about 40 million ounces in 2019. And the price of silver is plugging along around $14, $15 an ounce. 2020, 2021, investors step up and they're buying 87 million ounces or so and a little bit more than 100 million ounces of silver in 2020 and 2021. And the silver price rises sharply to $28, $30 on an intraday basis, $24, $25, $26 on an annual average basis. Last year, they bought about 37 million ounces on a net basis. There was a tremendous amount of silver buying by investors worldwide, and there was a tremendous amount of selling by investors worldwide last year. And we saw the silver price spike higher in the first quarter, partly because of recession fears and partly because of inflation fears and partly because the Russians invaded Ukraine. And then the silver price came down from around $28 to very low levels over the course of the period from March into September. That was investors buying less silver and in some cases selling their silver. And the silver price actually was off a little bit last year. This year we think that investors are going to buy more silver again and the price is going to rise. Maybe not in the period from late May through August, September, but in the first part of the year we saw strong demand, and we probably will see strong demand in the last 3 or 4 months of the year. So that's the mechanics that you see. Investment demand for physical silver drives the long-term price. The long-term price then drives mine production, secondary recovery, and fabrication demand. And investors aren't buying hundreds of millions of ounces of silver like they've never bought before. They're buying significant amounts of silver as they have done before in similar economic conditions. So we hope that you tune in next Tuesday. We won't be doing one of these videos next Tuesday because we're going to be doing the Silver Yearbook briefing. Again, you can go to our website and you can register to plug in to that briefing next Tuesday. And we will be talking for probably more than an hour about the fundamentals of the silver market, including how all that silver moved from London to India, and then 30% of it moved from India to other parts of Asia. The Indian banks and brokerage houses being intermediaries, taking advantage of the arbitrage that they could do between London and Mumbai, and then profiting further by then selling about 30% of that silver that they bought out of London into other Asian markets. Tune in next week. In the meantime, Take care. Have a good weekend. Take care of yourself. Take care of those around you. Try to do something good for the world. Goodbye.